Hello guys, and welcome back to a new video. Today I'm going to share with you one of the most powerful entry models there is. After 4 years of trading, I have tested dozens of entry models, alright? And from my own experience, the one that I'm going to show you today is the one that has the highest win rate. And this one is backed by logic and also statistical data. Let's not waste any more time and let's get right into it. The structure of this video is going to be as follows. First of all, I'm going to show you the entry pattern, how it looks like, alright, and what you should look for. And then I'm going to share with you the logic behind it, so why this entry model is powerful and why it works more than it feels. And finally, I'm going to show you a couple of examples, chart examples, so you can really understand it and apply it in your trading. Alright, so let's talk about the entry model and how it looks like. First of all, before I show you how it looks like, you need to have a higher time frame confluence in order for you to start taking and looking for this entry pattern. All right, when you base your trade off a higher time frame point of interest and couple it with this entry pattern, you're gonna have a really good win rate. All right. And the point of interest, it can be anything, all right? It can be an EMA, price taps into it and reject, all right? It can be, I don't know, Bollinger Band, whatever, price taps into the extreme, and you're gonna look for that entry pattern right here. It can be supply and demand, zone order block, and then you're gonna look for it from here. It can be an imbalance, all right, single print. It can be something like this. So price takes a previous swing low, a previous daily low, weekly low, whatever, and then take it. So that's a higher time frame. You want to base your trade off a higher time frame zone, higher time frame point of interest. Now when you go to the lower time frame, this is the entry pattern. Let's say that price is trading to the downside, all right? We have a trend going on, something like this. And what you want to see is a quick move to the downside, all right? Let's stop here and let's talk about this move. This move needs to have volume, all right? Or it needs to be a displacement, meaning the leg from the high to the low, it needs to be at least 3 times or 4 times bigger than the rest. You don't need to measure it, but you're gonna see it, alright? It needs to be sudden, alright? You can obviously see that this leg right here is way bigger than the rest from here. So a sudden surge in volatility and price quickly traded to the downside. You can also see it or identify it by the size of the candles here. You will clearly see that the candles here are way bigger than the candles here. All right, so that's the first part of the entry model or the formation that you want to see. Most cases you're gonna see imbalances here in this leg, but this doesn't matter. Now this needs to happen. When these moves happen, it needs to tap into that point of interest or low, something like this. All right, so you don't want to see this. This is the point of interest and this is happening here. No, it needs to be on that point of interest. It taps into that point of interest. Now the next thing is you want to see something like this, a V-shape recovery. So the market was pretty much idle right here, or an average trend, and then suddenly a huge move to the downside, and then followed by an opposing move and fade this whole leg. All right, now not something like this. We don't need or want something like this. So this leg also faded this whole move, but you can see this is not the same as this one. All right, we need to see an identical leg, and it needs to fade this whole move to the downside. Now I'm not gonna talk about the logic right now, just how it looks like. And your confirmation is the break of that leg, the high of that leg, or the start of that leg, or the initiation, all right, the initial point, whatever. And now you're gonna look for longs. So this is the entry pattern. Again, you don't want to see something like this, slowly trading to here. So the price action right here is the same here, and then I don't know, displacement. No, you want to see a displacement to that point of interest followed by a displacement in the opposite direction. Now, that's how the entry pattern looks like. Let's talk about the logic. First of all, when we have this huge move to the downside, suddenly trading to the downside, now this means that a lot of sellers stepped in right here. Large sell orders, aggressive sellers, all right? You're gonna see imbalances. Most cases, you're gonna see imbalances right here. Now, when you see this move like this, you want to see a follow through, all right? Price maybe trades to here into that imbalances and then a follow through, all right? So the people who sold right here, who are aggressive in the selling right here, they're gonna continue the selling. But when you see something like this, price trades to here and it found no resistance from here. So when price returns back into that imbalances, all right, and the initial point of that leg, let me remove everything. You want to see sellers defending their positions, all right? People who sold from here, they're gonna defend their positions of that move right here and the trend continue. But when you see that this whole move has been faded, all right, this tells you that this was manipulation and there are a lot of trapped sellers right here. People are going to sell from here, all right? Retail traders, when they see this move right here, they're going to sell, all right? And also, why this move happened, sudden move to the upside, this tells you that the sells right here fueled the longs. There were orders, all right, buy limits that were put in right here. When they sold, the buyers got filled right here and price exploded to the upside. Now, people who sold on this move right here, they couldn't defend their positions from here. And just think about it. How many times you see a sudden move to the downside like this, all right, and then followed by an identical move, and then price trades to here. This doesn't happen that often, all right? It happens mostly during CPI or NFP, when we have a candle like this, when we take both buyers and sellers. But in most cases, when we have this formation right here, we tend to reverse, all right? Also, we need to make sure that when we take our entry, and regarding the entry, it's your choice where to enter, but you don't want to be greedy and put in your limit, something like this, all right? So this is your area to enter. Now, when you enter, you want to make sure that price is going to continue to the upside. So not something like this. And how you make sure of that is you need targets. Basically, you want to see, I don't know, price taps the high or takes the high of the leg, the pullback. This, if we consider this is a pullback, all right, you want to target the high that put in the low from here, and you need to make sure that you have a decent RR. Or you want to see an imbalance, a big imbalance on the upside, and price tends to seek to balance those imbalances, all right? So this is the pattern and the logic behind it. Now let me show you a couple of examples and you're going to see it better. This right here is the first example. This is a point of interest, all right? You can see this is on the 1 hour. Overall, we are bullish. We broke the highs from here, returned back. We have this zone here. Came back to it. There was also a low right here inside it. This is a potential point of interest. We don't know if it's going to reject price. This is why we need some confirmations on the lower time frame. All right, so this is the price action. Now let's go to the lower time frame and notice what happens here. All right, see the price action right here, a normal trend. This is the London session, and then this is New York. All right, that entry pattern usually happens during news, not news like CPI or NFP. I don't recommend that, but the usual 8:30 news. Sometimes it happens at the start of New York or whatever, but you can see the price action right here, the legs, and compare the leg here. So a quick move to the downside, a sudden move to the downside, a displacement, and look what happens, a V-shaped recovery. See the leg right here, these 4 candles, but look what happened right here. We didn't take the high, we didn't break the high or the start of that displacement, so this is not valid yet. One more time, quick move to the downside. This is on the 3-minute. If we have a time frame like the 15-second, this moved open from here, or the high to the low, it's gonna be something like this. It's gonna be something like this, a leg, all right? And then when we trade it to the upside, it's gonna be like this, all right? But on the 3-minute time frame, it's just one candle. So it's happening here, and it's also happening here. And then we broke that, so we faded that displacement to the downside. And what happens? We started, as you can see, a new trend. Of course, this is happening on a point of interest with the trend, all right? But you can see, in most cases, you won't get a deeper pullback, so you want to be aware of that and take your entry somewhere around here, all right? Let me give you another example. All right, this on the 30-minute, we have an uptrend, all right? Again, we have a break structure, return back into that zone right here. We put in the low, start trading to the upside, and then one more time trading below that low, mitigating deeper levels here, all right? And if we go to the lower time frame, this is also with the trend, all right? Just to make sure of that. And look what happened. Just notice the price action right here, all right? And then notice the leg from the high to the low. See that this is a displacement and different than the rest. You don't need to measure it, it's obvious. See the candles, the size of the candles, and see that we have left imbalances, all right? And quick move to the downside, breaking the low, displacement, and look what happens next. Price quickly reversed and faded this whole move. When we take the high from here, when we fade this whole move, this is your confirmation to go long. Again, this move right here needs to be like this, all right? A displacement against a displacement. Very important. Another example, this is on the 4-hour, or yeah, the 4-hour. We traded to that imbalance. This is also a point of interest, all right? On the 1-hour, we took the low from here, these lows, all right? Now, on the 30-minute, you can see that this is a displacement to the downside. Notice the size of the candles, all right? And what happens is we faded that move with a displacement, with another displacement. And this is your trigger to go long when we break the high, all right? Price came back and a new cycle, a new expansion begun, all right? If you want me guys to do a backtesting session about it, maybe during the weekend, and maybe give you more examples, all right? But make sure to backtest this, or first of all, you want to look for hindsight examples to know how it looks like, and then you're gonna go and backtest it. So I hope you like this video. If you have any other questions, you can always DM me on my Twitter account or leave a comment down below and I'll answer you as soon as I can. Now happy trading and good luck.